What if the next global market collapse isn't a catastrophe to fear, but the most profitable event of your lifetime? We've been told that crashes destroy wealth, that the smart money hides, runs, waits. But what if the truth is the opposite? What if the next crash scheduled for 2026 is less about loss and more about opportunity? Today we peel back the assumptions. We uncover the hidden mechanics of the financial system, the unseen trigger points, and how the stage has already been set for a crash that could change who wins and who loses. To understand why 2026 may be pivotal, we must go back. In the wake of the 2008 collapse, central banks around the world flooded markets with liquidity. Low interest rates became the norm. Debt soared. Asset prices ballooned. Key figures emerged. Economists warning of bubbles, hedge fund managers quietly positioning for downturns. The system looked stable, but beneath the surface, structural fragilities mounted. Among them, sovereign debt at record levels, corporate leverage historically high, and speculative excesses in sectors like tech and credit. Meanwhile, cyclical theorists such as Martin A. Armstrong argue that financial crises follow repeating rhythms. Here one such cycle is approaching its peak. Wikipedia 1. So the stage is set, the players are in position, and a crack is forming. But what exactly triggers the collapse? And how could that collapse become the greatest wealth transfer in decades? The origins of our story lie in excess. After the 2008 crisis, policymakers declared never again. Yet the response created new problems. Governments borrowed freely. Central banks kept rates near zero. Corporations refinanced debt cheaply. Asset prices soared. For years, the logic, cheap money equals growth. But side effects were ignored. Misallocation of capital, bubble in valuations, and rising systemic risk. Debt to GDP ratios crept upward globally. Investors stretched for yield. The financial system became fragile, even while outwardly robust. Investors celebrated gains, ignored warnings, and assumed the authorities could handle any turbulence. The foundation was laid, a system reliant not on healthy growth, but on expanding credit, perpetual upside, and policy support. As we approached 2025, the rise phase was unmistakable. Stock indices set new highs. Tech companies reached valuations once reserved for entire economies. Real estate booms emerged in multiple countries. Borrowing costs stayed suppressed. Confidence surged. The assumption, this time is different. But what many missed was the fragility behind the ascent. One widely cited article warned, "Be ready for a stock market crash in 2026. Yahoo Finance, 2. It pointed out that while markets advanced, underlying fundamentals growth, productivity, debt servicing were weakening. The gap between pricing and reality widened, greater than in effect, the rise was accelerating the eventual fall. Then comes the breaking point, the moment when the assumptions fail. When leverage becomes a liability, when debt servicing can't be ignored, when policy support fades or runs out. Imagine a sudden interest rate shock, perhaps triggered by inflation, a credit event, or a geopolitical shock. The cheap borrowing era ends. Borrowers scramble, asset prices roll over, margin calls cascade. In 2026, according to multiple analysts, the combination of high corporate debt maturities, stretched valuations, and policy constraints could trigger exactly that. A crash, yes, but not just a crash. A reset. What happens next is what matters. Because when asset prices fall, the very wealthy don't always lose. They often buy. They acquire distressed assets. They capitalize where others panic. A crash typically destroys value, but paradoxically, it also creates value, especially for those with capital, conviction, and the ability to act when others cannot. In the fallout of the crash, many will panic. Liquidity will flee. Credit will tighten, businesses will fail. Real estate markets will collapse in regions. Stocks will plunge. Yet, for a select few, those who anticipated, prepared, positioned, this is the moment of opportunity. Assets that were overpriced suddenly become bargains. Markets that were frothy become fertile. And capital moves to where fear once dominated. This is the richmaker portion of the crash. It is precisely when the system falters that fortunes are made. The key, to see the patterns, to prepare, and to act. After previous crashes, policymakers roll out fixes. Bailouts, stimulus, quantitative easing, rate cuts. They soothe markets. They restore confidence. But often those fixes delay the inevitable rather than solve the root problem. In the 2026 scenario, we might see massive central bank intervention, fiscal largesse, and emergency credit programs. But those will only prolong the cycle. They will create new distortions and plant seeds for the next crisis. Thus, the crash may be followed by a rescue that sets the stage for the next rise and the next breakdown. The cycle continues. The trick for you is to recognize the crash isn't the end, it's the inflection point. And if you follow the cycle, you can position for the rise that follows the crash too. The pattern isn't theoretical, it's already visible. Global debt has surpassed $300 trillion. Interest rates are rising even though growth is weak. Valuations stand at levels only seen before major market collapses. Wikipedia 3. Meanwhile, new bubbles are forming: tech, AI, credit markets echoing past successes, and policy space is thinner than ever. Central banks may not have the same arsenal in 2026 that they did in 2008. When you see history repeating, when you see debt, bubbles, policy constraints converging, you know the risk is rising, but you also know the opportunity is rising, because every major crash previously created generational wealth for those willing to act. Takeaway 1. A market crash isn't only a loss event, it's a reset moment, and for those prepared, it can be the birth of opportunity. Takeaway 2. The key to benefiting is positioning ahead of the crash capital. Liquidity, readiness to act, not reacting once the crash is underway. Takeaway 3. Recognize that policy fixes don't prevent collapses, they change their shape. The cycle of boom, bust, rescue, boom will continue. Your role is to navigate it, not pretend it won't happen. Here's your open question. Are you seeing this crash as a tragedy or as a turning point? Because if you're only prepared to fear loss, you'll miss the chance to gain from upheaval. But beware, the same forces that create opportunity can also erase it quickly. Preparation is not a guarantee, it's a responsibility. If this video has made you rethink what the next crash could mean, not just for danger, but for opportunity, then subscribe and stay tuned. We'll dive deeper into how to position for the crash, how to pick the assets that benefit, and how to shield yourself when the system shifts under our feet. Like this video, if you found it valuable, leave a comment below with your thoughts on 2026, and share this with someone who still thinks crash means only loss. Because in 2026, the crash could make you rich, but only if you're ready for it.